Bill, I guess, is this now the key number that you have to watch when it comes to the economic impact of the coronavirus here in the United States?
Well, we know that unemployment's going to extremely high levels, probably 15%, maybe on its way to 20%. So I think that market participants are well aware of how bad this number is going to be.
So if these numbers come to fruition, it would almost represent about 1 in every 8 working Americans out of work this time around. How exactly is that then going to play out in terms of market expectations for when this economy can actually get restarted in a substantial capacity?
Well, I think that has very much to do with the health issues. But one thing that is very clear is this is not a garden variety recession. This is something much, much worse than that economically. And that's why the government has stepped up in such a big way.
Have you seen any kind of reverberations in the credit markets because of this? I would think intuitively, as the economy gets worse, as the macro conditions deteriorate, corporate risk goes higher, yet we are seeing this level here where treasuries continue to kind of move lower in terms of yields. What exactly are companies paying to borrow money to shore up those balance sheets they need in the coming months?
Well, borrowing rates have gone up, even though the Fed has lowered the Fed funds rate by 150 basis points. If you go to the low point of the market on March 23rd, investment grade companies had to pay 2 percentage points more than they were in mid-February, and high yield companies 6 percentage points more. So that's one reason why the government has stepped up in such a big way, is to bring those borrowing rates back down much closer to where they were prior to the health crisis.
So in other words, what you're saying is that spreads have kind of widened out. That's the terminology, right? That companies are now paying more over comparable maturity treasury bonds. That indicates that risk is higher and investors or creditors are demanding more in interest payments. What industries specifically or in particular are seeing the most stress right now in your mind?
I mean, it's across the board, but energy is under particular pressure. Retail is under particular pressure. And then anything leisure related, travel related, of course, is really bearing the brunt of it. But it's really across the board.
All right. So has the stress then created opportunities? As these markets have dislocated in some way, are there places you can say, hey, things have sold off too much. Maybe now is a good risk reward for us to dip in?
Oh, absolutely. The returns from this point forward should be fantastic in the credit markets. And it starts with the investment grade market, where the government has really attenuated the downside risk in that part of the market. And spreads went from 100 basis points to 400 basis points on March 23rd. They're back down to below 250 basis points, but they're probably heading closer to 100 basis points over time. So there's still plenty of time to generate very strong returns in investment grade credit.
So investment grade credit is the place that a lot of people are watching, but that ship may have sailed. I mean, those investment grade bonds have already surged in value since the lows that we saw a month ago. We haven't seen as much of a catch up in high yield parts of the market. Are those junk type bonds something that you can look at now and say, hey, 12 months, 18, 24 months from now, they're a good investment?
Absolutely. Now, I'd stay up in quality. You might want to start with the fallen angels or the expected fallen angels, because you're still getting some very strong government support in that part of the market. And then beyond that, you want to stick with higher quality, high yield bonds, and probably bonds that are not in the ETFs, or that are much smaller weights in the ETFs, because the fact that the government is buying the high yield ETFs, or can buy the high yield ETFs, has led to somewhat of an extreme move up on the ETF bonds. So I would focus elsewhere, but again, stay up in quality in the high yield market.